I'm looking at a stock, Morgan Stanley, right, which seems like everybody loves. I think Joe owns it, among others, and Joe can comment on it after I ask you this question. Downgraded on valuation at Oppenheimer after a big run. Downgraded yesterday at Berenberg. No room to run. No absolute upside is what they say. What's your rating on Morgan Stanley?
Well, we do recommend 4 of the 5 large banks, so led by Bank America and certainly JP Morgan, and then some regional banks like US Bancorp and PNC. But we do have a hold or neutral rating on Morgan Stanley. We think their structural change has gone a long way. Last decade, as you know, it was our top pick for a number of years, but that's, you can't dance with everybody. So we're on the sidelines with them, but we do see tremendous.
Well, you're dancing with everybody else. I mean, come on. I mean, I feel like you're like going out of your way to avoid saying anything negative about Morgan Stanley. I mean, you're literally dancing with everybody else, but you left Morgan Stanley on the bench. What's up with that?
Well, the jury is out on some of their acquisitions. You don't decide on the success of an acquisition in, the first few months. It takes a couple of years to really see how they're going to integrate E-Trade. James Gorman, the CEO of Morgan Stanley, he was extremely lucky with the timing of the E-Trade acquisition, but you still have some heavy lifting to do to see the follow through, through a full cycle. So, we'd rather be on the sideline. When you look at, generating organic revenue growth, Goldman Sachs is more proven at doing that, through cycles. And back to our tech is driving banks theme. Goldman Sachs is a microcosm of the industry. Banks retooled their technology for the last decade. You didn't see the benefit of that until revenues came back, and then they have record profit margins on these new revenues. And they have some traditional banking revenues, but when those come back, you're going to see record profit margins on traditional banking revenues too.
Joe, I want you to address this. I mean, here you have the #1 ranked bank analyst coming out and saying, I like everything. I'll have every flavor in the cabinet except for the one that you like. And he's not the only one, because I mentioned the downgrades of Morgan Stanley by other people too. So are we all off sides?
I'm not selling. Not selling. They doubled the dividend, 3.1% yield right now. When you look at the wealth management business, the growth is still there. You look at the capital market business, the growth is there. If you look at trading activity, they're #1 in terms of market share for the equities division. If you take the big 5 and you study the prior earnings report, you'll see the biggest declines in equities in the other 4, not in Morgan Stanley. So I'm not selling. I'm very happy with the position. I'm going to stay right where I am.
Let me ask you this. A defiant Joe Terranova says, Mike Mayo. What happens? So Elizabeth Warren calls the Fed chair a dangerous man, obviously over the top. I don't need to say that. I think we're all thinking the same thing on that. Well, most of us anyway. But seriously, what happens, though, if you get a different Fed chair, more favorable to progressives, that isn't as generous, if you want to use that word, towards the banks?
Well, I'm going to repeat one point that I'll address your question. This tech-driven revolution at banks cuts through the rate, economic, and political cycles, and it's underappreciated at banks. When it comes to regulation, that does go in cycles. Remember, Dodd-Frank is was passed under a Democratic administration. So, and it's done a great job. It made banks extremely resilient. And Exhibit A for bank resiliency is through the pandemic, when banks acted as a source of strength, as opposed to a source of weakness during the global financial crisis, which I talked to you about, over a decade ago. So, Fed chairs come and go, politicians come and go, rate and economic cycles come and go, but loan growth is going to come back regardless. Our house view is rates go higher regardless, and our new big report says that profit margins go higher regardless. So our bullish bank call transcends any one Fed chairman.
Dr. J, I'm quoting your notes today. I'm loaded up on the financials. JP Morgan shares, B of A calls, Wells Fargo calls, Capital One calls, KeyBank calls, Square calls. So you agree then, it seems quite obviously, with Mr. Mayo's assessment?
I do, Scott. And, we always enjoy Michael when he comes on, even without props, Mike. But I love the idea that this is a sector that's up 47%. Of course, it screamed higher in the first 2 months of the year, Scott, and then sort of like some of the material stocks as that infrastructure bill dragged on, they bled off. The banks did. Those infrastructure stocks like Cliffs, like Rio Tinto and so forth bled off. But the banks came back with a vengeance. And like I say, that's why they are the second best performing group right now. 47% is nothing to sneeze at. I think it goes higher still, Scott, but not because we jump over 2%, but because we just hold on to these higher rates here, and because the consumer then decides that in a stable economy, which we are getting towards, that they can go out and get those loans for whatever purposes, buy a new car, work on the house, whatever it is. The consumer loan portfolios at some of these banks is going to make them more attractive, and then commercial as well.
Hey, Mike.
Scott, let me just add to that. From a bottom-up perspective, almost every large bank that we talk to, and as you know, I've covered the space for 3 decades, they're saying activity is picking up across the board.
Yep.
And so loan growth traditionally has followed it. It could be a quarter, it could be a couple quarters, but it's in sight. And once you get that loan growth picking up with any degree of higher rates, you're going to see more of those revenues fall to the bottom line than ever before. And that's what's still missed with the bank stock investing.
We'll leave it there. Mr. Mayo, appreciate it. As always, Mike Mayo, Wells Fargo Securities. We'll see you soon. Don't worry, Joe. I see the look on your face. I'll get you next time, okay? Camera don't lie, Joe. The energy sector soaring 75% in a year. It's not slowing down. Recently up 10% this month. Famed commodity trader Mark Fisher joins us next for his take on that. Joe's going to get a question, at least one. I promise. We're back in 2 minutes.